Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Paul Curcio, and I am the managing editor of ETF.com. And joining me today is ETF.com's first-rate team of writers and editors. We have senior ETF analyst Sumit Roy, senior content editor Kent Tooney, contributing editor Ron Day, and financial reporter DJ Shaw. So we have a lot to cover. Let's dive right in. It is earnings season, and even though it's the second quarter of earnings here at the end of July, it's not really a barn burner for big news most of the time for these reports, but there's still many high-profile stocks and corresponding ETFs to watch. For instance, two of the Magnificent Seven stocks, Google, Alphabet, I should say, and Tesla have reported as of Wednesday evening, leaving the remainder, Amazon, Apple, Meta, Microsoft, and NVIDIA, still to come. But those first two are really important. Now, Sumit, considering the market's remarkable run-up since April, what does the recent action in these stocks signal for ETF investors?
To me, it signals that the Magnificent Seven, we consider them as one homogeneous group. They're not necessarily that. They each have their own fundamentals and they go their own way. And that's exactly what we saw with the two Mag 7 stocks that reported this week, Tesla and Alphabet. They went their separate ways. On Thursday, the day that they began trading after reporting earnings, Tesla actually fell by around 9 to 10% or so after its earnings. On the other hand, Alphabet spiked about 2, 3, 4%. And we all know the reasons for why Tesla has been struggling. We've talked about it many times. Obviously, the brand struggles when it comes to Tesla, the competition from other automakers when it comes to EVs in general. Those are weighing on Tesla. And we saw that in the results. Revenues for the company in the second quarter dropped by 12% year over year. That's the steepest year over year decline for Tesla sales since 2012. So the core EV business is really, really struggling. Hence, we got that drop in the stock. But it wasn't surprising, right? A few weeks ago, the company told us how many cars it had delivered, and that was already down 14% year over year. We know the business is struggling. We know that. But why, you might ask, did the stock then react so violently to the downside this week when people already knew things were bad? I think it's ultimately because Elon said that things are going to stay bad for the next year or so. He said the Q3, Q4, even into the first half of next year could be a challenge for the company. So I think some investors were hoping that there could be some light at the end of the tunnel sooner than that, and he didn't really say that. Instead, investors are left with this futuristic vision about autonomous vehicles and humanoid robots. That is still, obviously the dream when it comes to Tesla. And Musk said a lot of things about that. He said the Austin robo-taxi pilot that they started in June, he hopes that expands to half the nation by the end of the year. I mean, we're talking in the next 6 months, he thinks that could expand pretty dramatically. So we'll see if that happens. He also said that he wants to begin scaling up production of the humanoid robots next year. And he hopes that within the next 5 years, Tesla could be producing over 1 million humanoid robots. So these are very, very lofty goals. And I think, if he can hit those targets, this could be a very, very valuable company in the future. But of course, on the other side, you got the EV business, which is the here and now, and that's really struggling. So you put these two things together and you essentially have a stock that's range bound, right? Tesla has been range bound for the past 5 years between 200 to 400, call it. Sometimes it spikes above and below that range, but
That's a pretty big range, though.
Yeah, it's a huge range. I mean, but Tesla's a volatile stock, so you expect nothing less from that type of company. So that's Tesla. Obviously things are kind of a struggle right now. We'll see what happens with that.
Alphabet. What about the short? Before we get to Alphabet,
Yeah.
what about the Tesla short ETF? Is this a good time, considering Elon's warning? Is this a good time to jump in?
I think you only jump in if you're a short-term trader, you're looking at the charts and things like that. I don't think it's a great idea to, buy this and hold this type of ETF for the long term. Because as we've talked about many times, these leveraged ETFs, these inverse ETFs, they decay over time. It's just the math behind them. They rebalance every day. So even if you're right about the direction, you could be lose money still, just the way these ETFs work. So yeah, if you have a short-term thesis, you think the next 2 quarters are going to be bad for Tesla. The stock's going to drop to 250, 200. Go ahead. TSLQ is out there. It's for aggressive traders, but just be wary about holding it for long periods of time. You're gonna probably lose money.
Well, just ask the Tesla shorts that tried going up against Elon for years and years and years until
Exactly.
this past year or so.
Yeah.
They finally got a couple of wins in there, but shorting Tesla's
Yeah.
hasn't been a great idea.
Exactly. I saw a really interesting tweet actually, Paul, on Twitter. Someone said, he really respects everything Elon has done when it comes to EVs and things like that. But the most impressive thing Elon has done is put together such a dedicated investor base that has, lived with him through thick and thin, just does not abandon the stock no matter what happens. And that is pretty impressive. I mean, every stock has a different investor base, and this is one of the strongest, most committed ones in the entire market.
Now, Alphabet also reported on Wednesday evening, and it's got its own issues that it's got to look at. What are you
Yeah.
seeing for ETF investors? What are you seeing for Alphabet, and where does AI play a role in all this?
Yeah, so Alphabet has been kind of a lagger when it comes to the Mag 7. Even after rallying on Thursday, it's only up 3% year to date or so, which is far less than something like QQQ, which is up 11%. And the main reason for that is people are worried that chat bots like ChatGPT are going to disrupt Google's search business, right? If more and more people use chat bots to get information, why do you even have to go to Google? That's the idea. But so far, we're not seeing it in the numbers. I mean, Google's overall revenues grew 14% year over year in Q2, and the search business grew 12% year over year in Q2 as well. So it seems to be holding in there. And I think a reason for that is Google is adapting to the new environment. If you go to Google, I still use it, even though I'm using chatbots as well. You'll see that they have that AI overview at the top. There's also an AI mode. So search is evolving, and so far it's not being negatively impacted by what's going on in terms of AI. So that's a positive. Another positive is the Gemini chatbot that Google has, which competes with OpenAI's ChatGPT. Apparently, that now has 450 million users. So significant user base there. It lags ChatGPT, which has, I think, 800 million to a billion users, but still, quite a user base there when it comes to Gemini. And finally, investors were also happy to learn that Google's cloud business continues to do extremely well. Growth was around 32% year over year. This is Google Cloud, where they rent out computing power to other companies. They also rent out or provide services to other companies. And this has been very, very strong. And it's the reason that Google is increasing its CapEx estimate from $75 billion this year to $85 billion this year. Normally, the market doesn't like to see companies, spend so much on CapEx, raise it so dramatically. But in this case, Google said they're raising it because demand for AI is just so astronomical. They need to invest in these data centers. They need to buy NVIDIA chips to power these data centers. So there is demand out there, and that's why they're investing more heavily in AI. And that's the reason also we saw NVIDIA hit record highs after the Google earnings report. We saw Broadcom, which makes Google's custom AI chips, the TPUs, it also hit record highs after the Google earnings. So everything seems strong on the AI front, and we'll see what happens next week when 4 other Magnificent Seven members report.
Interesting. So that sparked a couple of thoughts in my head. First is that Ron has actually written about market concentration recently, and Mag 7 being a really important part of what's been driving the market. Ron, what is it that you were pointing out in this market concentration and the ETFs, the underlying ETFs that help investors to profit from that with these Mag 7 tech stocks driving so much of the market and how it's cutting off other types of investable ideas?
market concentration has been a theme for 2-3 years now. We've all been hearing about the market is kind of precariously balanced, like an upside down pyramid, with the Mag 7, responsible for, I think I read it was 30% of all the gains. Market concentration is at its greatest in like almost 100 years, since 1932. So, market pros like our own Kent Tooney, CFP, point out that there are red flags to this, that is potentially going on, or a potential problem, is that underneath all of this, these huge gains, these 30% being driven by 7 companies, is what about what's going on underneath? You raise the hood. The other 493 companies in the S&P 500.
They don't matter. Who cares about them?
They clearly don't matter. I mean, it's wild that NVIDIA is a $4 trillion company. And at the bottom of the S&P 500, you have Enphase, which is not even a $5 billion company. So, I mean, there's this huge breadth in values, but then it just, it really kind of coalesces into this incredible point at the top.
And it all gets connected. So, Kent, I mentioned earlier that the market has been on this incredible run since President Trump paused tariffs in April. And you wrote a story about this week, posing a very simple question around VOO, VOO, Vanguard's S&P 500 ETF. Can the S&P reach higher highs in 2025, or has this bull market run its course? And of course, where does the Mag 7 in this market concentration fit into all of this? What say you, sir?
Well, yeah, I would add to that, Paul. I wrote on QQQ as well, a similar story. So yeah, like Ron said, the Mag 7 makes up a large amount, over 30% of the Vanguard 500 index, VOO, or the S&P 500 index. But it makes up over 45% of QQQ, another hugely popular ETF. Yeah. But answering the same question, I mean, can they continue to go to reach all-time highs? The S&P 500 has reached another one today. The NASDAQ 100 is near one as well, as we record this on Thursday. But yeah, I mean, I was noting, going back to QQQ, especially in light of the Mag 7, it was up over 35% since the market low on April 8th. The post-Liberation Day tariff pause, whatever you want to call it. And Samit mentioned that it was up 11% year to date, but looking at since that post-tariff pause, that leads into what do we need for the market to continue going higher, whether you're looking at the S&P 500 or the NASDAQ 100, however you want to slice it. It's headwinds that are in the way that need to be reduced or removed. The biggest headwinds that any investor would agree upon, but just can't can't nail it down and really decide how it's going to impact. No one really knows is tariffs. I mean, we need more trade deals, or Trump needs to make more trade deals, especially with larger trading partners like the European Union and China, not just smaller ones, Indonesia or whatever the ones he's working on. We also need to see slower inflation, or even some falling prices in some of the bigger items in that inflation basket, autos and housing. Be great to see some of those prices come down. Lower interest rates as a result of all these things by justified signs of slower inflation. These are things that are headwinds coming and they need to be removed. But however, the market continues to go higher. I mean, we've called it different things like climbing a wall of worry, which is when the market can continue to go higher, even though there are concerns that are there.
I like to call it a melt up in this, because
melt up, FOMO, or what Keynes called, animal spirits, whatever you want to call it. There's a growing disconnection between the stock market and the broader economy. Even the leading economic index, the indicators that came out, I believe that was Monday, or maybe it was Friday. But anyway, the only part of that index, or the key part of the index that's positive, is the stock market, but everything else is negative. I mean, so it just tells you that the leading indicators are pointing to a slower economy, but the stock market continues to go higher. So that's the only thing that can really, to answer the question in a long answer, can the market go higher? Absolutely, as long as investors believe that it can just keep on going.
So as the kids put it, maybe it's time to voo and chill.
Yeah, it could be. I like diversification. I think that's going to end up being a story of 2025 on a serious note. But um, since April 8th, it's been all about tech. S&P 500 is a good way to capture it, but it'll be interesting to see what goes on in the second half of the year.
Definitely. And there's more to it than that. It's not just equities that are moving. The cryptocurrencies have been pretty active. So Ron, you've been following the resurgence of Ethereum for quite a while now, watching the cryptocurrency and its corresponding ETF, ETHA, rise from the doldrums and set new records for inflows. Now with Bitcoin sitting just below its highs, what's fueling this Ethereum surge? And should investors be wary or be greedy right now?
I think this, okay, disclaimer. I'm just going to say, speaking personally, I say greedy. I know we're getting a little ahead of the, flirt, marry, kill. But this seems to
We're
be
not
a
playing
good.
today, so it's
Okay, all right.
where you're
This is a
greedy.
very short section. I'm going to say I'm saying marry, but really, I mean, we had crypto week a couple weeks ago, right? That was a big. I mean, and Ether and Ethereum itself went through the roof. Ether, I think, was at, I don't know where it is today, but it went from $3,000 to $4,000 in just a matter of weeks. I think it's now taken in 10 billion of flows since they launched about a year ago, right? Because the anniversary was 2 days ago. They began trading January 23rd, 2024. They brought in 10 billion. And I think 4/5 of that, again, has only been over the past 6 weeks. It's just been this remarkable amount of money like flooding into it. And we got I guess it's just hope for, increased usage of the Ether token with the Clarity Act, the Genius Act, and general, like, rah rah cheerleading in the White House, where, we have people who are not shy to say they are putting their money into these things, or their, not so blind trusts are investing vast amounts of money in crypto ETFs, crypto, or starting crypto ETFs.
Yeah, there's money going in. I saw some news this morning that Peter Thiel took a position, one of his investing arms took a position in Ethereum recently. So, a big one. So people are following suit. There's something going on, and there's something happening here. What it is ain't exactly clear.
No, that's for sure.
All right. So moving a lot right along, DJ, earlier this week, you covered a webinar hosted by Rick Edelman, who's a leading figure in the RIA industry and also happens to be a member of our editorial board. He declared the traditional 60/40 portfolio allocation of stocks and bonds to be, and I quote, dead and obsolete. A severe statement. So what's his reformulation of the 60/40 rule, and how does it involve ETFs?
Yeah, he said it dead and obsolete, and he wasn't subtle about it. He argued that the old model just doesn't work anymore because for two major reasons. One, people are living longer than ever, and two, technologies like AI, biotech, and blockchain are reshaping the investment landscape. So his alternative, he's proposing a new allocation framework where portfolios are made up of 70 to 100% of stocks and crypto, with 0 to 30% in bonds, which it's a massive kind of shift away from bonds, which has been sort of standard in retirement planning for as long as, retirement planning has been around decades. So how does crypto fit into this? Well, Edelman recommends that investors allocate between 10 to 40% to crypto, depending on their risk tolerance.
Now, is that
He
in lieu of bonds, say, so have a 60% stocks and then
Well,
just
I think
eschew bonds, or split the 40 between bonds and crypto?
it depends on how much risk you're willing to take. So if you do, so his idea was that conservative investors would go with 10% crypto, moderate with 25, and aggressive investors, they would go as high as 40. So if you, that kind of leaves space for bonds, depending just, how much risk you're willing to take. And when you look at ETFs, argued that crypto is no longer this fringe asset class. We now have spot Bitcoin, Ethereum, XRP, Solana. So it makes it a lot easier for and safer for financial advisors and investors to get exposure to digital assets. Coinbase Asset Management was also part of the presentation. They talked about how advisors can use tools like Bitcoin yield funds, buffer ETFs, or tokenization products to access crypto in a more controlled and diversified way. So this webinar was interesting, and one thing that stood out is that Edelman's whole argument wasn't just about performance, it was about longevity, people living into their 90s and 100s, and how traditional portfolios might run out of money before people run out of life. And he argues that without a growth engine like crypto in the mix, a portfolio just won't be able to keep up, especially when more traditional projections still assume clients will pass away at 85 or 90.
And just as a matter of disclosure, for anybody who's not familiar with Rick Edelman, he, as well as being an RIA guru, he's also the founder of the Digital Assets Council of Financial Professionals. He has been a longtime advocate of crypto and has skin in the game there. So it's not surprising that he takes this point of view.
Well, he backed up, some of these projections.
Oh yeah, he backs it up. He's
with examples. He said he thinks Bitcoin could hit 500,000 by 2030. He cited the growing imbalance between supply and institutional demand. He said that in the first quarter, publicly traded companies bought 95,000 Bitcoins, while there were only 41,000 newly mined Bitcoins. So he's rethinking about just swapping out isn't just about swapping out bonds for crypto. It's just more in general just a response to longer lifespans, faster innovation, and increasing maturity of the crypto market. And I think he sees that, or says that ETFs are a way to make crypto more accessible to everyday investors.
Great reporting, good story, and something to definitely think about. So on that note, I'd like to thank all our listeners for streaming or downloading Exchange Traded Fridays. And remember, if you haven't already, please like, subscribe, or follow us wherever you get your podcasts, whether it's Apple Music, Spotify, Amazon, or YouTube. If you have a question or just want to share your thoughts, join the conversation with us on X, formerly known as Twitter, where our handle is @ETFCOM. All right. Thanks for joining us, and see you next Friday.